But final topic, cash flow forecasting, burn discipline and financial planning for 2026.
There's an article that Sifted has just written which says that VCs have raised 60% less funding this year than previously. So I just want to let that sink in for a second, right? There has been 60% less capital raised by VCs. What does that mean? That there is 60% less capital that VCs are going to deploy downwards into startups, right? Potentially. So the first and foremost point I would make is, can you get to a point where you don't need to raise, or that you can raise on your own terms, i.e. that you are generating profitable revenue and are scaling at pace such that any additional capital that you raise is only purely going towards growth, which is what it should be doing in any case, right? But I think if you find that you are burning millions and your revenue is not of the right quality and your unit economics aren't working, it is going to be harder. So first off the bat, can you get away with not raising capital? And if you do need to raise capital, are you showing the sort of quality of profile of business that you would need to? The second point within all of this is that, you know, we've seen it. 3 years ago, it would take you 3 months to close a round. That crept up to like 4 or 5 months. That's now going up to 9 months. Now, that's not always the case. Hot deals are still getting funded, and that's what you're going to see in the news. But just assume you're not the hot deal, right? It's going to take you somewhere between 6 and 9 months to close a round. So always assume you've got less time than you anticipated. But the thing that frustrates me the most is founders going out to raise with 4 months of runway, because you're just like, wow, this is going to be really tough. So you know, forecast on the basis that you've got less time than you thought. Always forecast on the basis that your revenue is not going to achieve what you think it's going to achieve, right? Even if that isn't what you're putting out externally, internally, you want to assume that your revenue forecasts are off by 30 to 50%. Again, we're seeing this again and again. But rule of thumb, you know, 3 to 5 year forecast for investors, 12-month forecast for yourself, and if you need it, rolling 12-week cash flow for operations. But I know Joe also has views. So
yeah, number one, I hate doing weekly cash flows. I mean, you know, I think they become an absolute drain on finance, and I'm sure anyone in this call that's done one will agree with me. They take the focus away completely from talking about strategic growth and other such items. But back to your question, it was specifically, how can you build an investor-ready cash flow for a financial model, right? Number one, make it simple, make it malleable, and particularly in these times, make it realistic. Investors do want to see growth, right? 3x, 2x, whatever the numbers are. Don't go from 1 million revenue to 150 million revenue in 4 years, because no one's going to believe you anyway. And I think aside of that, irrelevant of what you're doing for this particular round or this investment, that model you're building is not going to be used operationally to manage your business. Don't try and build your entire operational processes or all of your supplier payment terms, all of your debtor payment terms in there, right? All that kind of stuff. This is literally just for illustration purposes to show what revenue that you want to get to and roughly what month you might run out of cash. And as soon as you start, as soon as you start building in daily operational cash flows or payments of credit cards on the 15th and whatever else, you've lost it, right? And then both of them will be unfit for purpose. It won't be fit for an investor model. It won't be fit for an operational model.
So I'd add to that. So we worked with a client, I'm going to say it was probably about summer last year now that I think about it. We got a call from the founder who'd been introduced to us by another client of ours. They were in the middle of a round. They were talking to a VC, and the VC basically said to them, the model that you've got is absolutely awful. They called us in. We had a look at it. Joe basically rebuilt it within about 2 days, I think, if I'm not mistaken. But that model was hard-coded, was not dynamic. Like, you couldn't change an input to get a changed output. And sad as I am to say this, the finance director that they had in place said this was one of the best models that they'd ever built. And frankly, you know, they didn't think the business was going to go anywhere. So, you know, kind of trounced off in a bit of a huff. They went from almost raising $1 million or so from an EIS fund in the UK to raising 8 million from a tier one fund in the US. Now, I'm not saying that it was because our model was amazing. I mean, our model would have been great.
I mean, it ticked the 3 boxes, right? It was simple, it was malleable, and it was realistic.
Exactly. So the main thing I would say, and I think this is what people get wrong all the time, overcomplication, exactly as Joe said, keep it simple. Overcomplicate it at your own risk, because why? The more complication you add in, the easier it is to pick out kind of points, right? And find errors. If you have one revenue stream but are planning 4, just keep one revenue stream. Like the more revenue streams you have, the more opportunity there is to challenge that. Break out your head count. Make sure that you are breaking out the obvious stuff that every investor is going to want to know, right? Like, why are you hiring 30 people in Q1 26? Can you get away with 10 or whatever the numbers are, right? Make sure it's not hard coded. 3 statements. What you want is assumptions on one page, 3 statements on the next page. That's an investor model, right? Most of those guys are used to seeing IB models, which are even like more simple than that, right? So 100% echo what Joe says. Keep it simple, keep it malleable, and don't overcomplicate, for sure.
Excellent. Thank you, guys. And you've actually just teed us up perfectly for the last couple of minutes. You kind of touched on this already, but the final part for the cash flow forecasting piece was combining pipeline, hiring plan, and cost base into one source of truth. So in a couple of minutes, how would you advise on the best method?
Well, I would say, irrelevant of those 3 criteria, one of the things for me that's really important when building out not an investor model but a proper cash flow for the business, ones that we're using internally, is to know what your contingency and your backup plans are, right? I guarantee that any budget any of us are doing for 2026 that's completed by the end of this month will be wrong by the end of January, right? If they're not, they're all going to be wrong by the end of Feb. So one example I've had recently is, what happens if our sales are A, B, and C, right? And the answer is, okay, by the 15th of May, you may have to look at your headcount costs, or by the 16th of June, we would then have to remove contractors, right? Or by X date, you would have to do this. And if your revenue is moving by this much, then these are the contingency plans we have in place, right? Often, pipeline is the killer for true forecasting when you're looking at the funnel and conversion rates and the timelines and sales teams sandbagging and pushing stuff out. But from a finance perspective, getting all of that information into one place and understanding it shouldn't be too difficult if you've got the help from the other team members. For me, it's all about contingency planning and scenario planning.
Yeah, I think the other thing, and Joe, don't know what your thoughts are on this, but don't try and integrate your CRM into your model. Don't try and integrate your payroll software into the model. Like that stuff, it's a lot easier, because for a start, certainly with your CRM, you just don't know how accurate the data is, right? Like if your sales team aren't keeping the CRM bang up to date every day, you're just going to end up with like wrong assumptions creeping in, and they'll compound over time. So I always try and get a snapshot of what is realistic today, build out our assumptions about what is likely to happen over the next 12 months, but keep it in a really simple way. Like the minute you have data pulling in from other sources, that data can change, and that will shift your model, and then your model is continuously shifting. Whereas if it's static, at least at the starting point, you can manually change it, and you should be rolling your forecast every 3 months potentially. I think the big error that, again, going back to that original point, the big error that lots of people make in finance is overcomplicating. Like, why is a model useful? A model is useful not because it absolutely reflects 100% what is happening on the ground, because that's impossible. But a model should be sufficient to be able to, to use as a map, right? So it doesn't reflect reality, but it gives you a good enough indication of where you're heading. And yes, keeping those things as a source of truth. So your pipeline, your head count, and your costs. Yeah, but those are so your head count and your costs should be within your control, right? because that's your business. You should be able to say, well, I'm going to hire this person, I'm going to fire this person, I'm going to reduce this cost or whatever. Your CRM is the thing that is most variable, right? And actually that is the reality of what most modeling is about, is how accurately or how well can I predict how our revenue is going to. So I would be focusing like 90% of my time, 95% of my time on making sure that my revenue pipeline is as good as possible in terms of how I've modeled it, and everything else flows down from there.
And also definitely have that contingency plan. So you need to have scenario 1, 2, and 3 by the sounds of it, especially as we go into even more on economic uncertainty next year. But thank you all so much for joining, and thanks again to our panelists, Joe and Aarish.